This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View on this Friday. I'm Andrew Gagan. Good to have you with us again here at AusBiz. So let's check what happened on global markets overnight. Risk-off sentiment returning. Tech and consumer discretionary stocks led the losses on Wall Street, with all three major US indices sliding on concerns of stretched valuations, particularly in AI-related momentum shares. The tech-heavy Nasdaq losing almost 2%. Among the mega-cap tech stocks, Nvidia extended its 5-day losing streak. And Tesla also falling ahead of results of the shareholder vote on Elon Musk's $1 trillion pay package, which they subsequently approved. More than 75% of investors voting in support of the pay package. However, to earn the full amount, he must boost Tesla's market value by $8.5 trillion by 2035. Other conditions include Tesla selling 12 million vehicles a year and deploying 1 million robotaxis and 1 million humanoid robots. Elsewhere, shares of chipmaker Qualcomm dropped after warning that its chips may not be as dominant as before in future Samsung gadgets. Australian-based Iron tumbled, having surged early in the week after signing a multi-billion-dollar deal with Microsoft. Marvell Technology rose on reports that SoftBank explored a potential takeover of the company. Warner Brothers Discovery posted a larger than expected quarterly loss on lackluster growth in its streaming unit. DoorDash shares plummeted after the delivery firm reported third quarter profit below Wall Street expectations on rising expenses. Novavax deferred its target to become profitable by a year to 2028 as changes in US vaccination policy have dampened its COVID-19 vaccine sales, and cosmetics maker Elf Beauty forecast annual sales and profit below expectations, sending its shares tumbling. Snap shares surged after the social media firm beat third quarter revenue estimates and announced a partnership with Perplexity AI. And Tapestry raised its annual targets but forecast holiday quarter earnings below expectations. Well, US-based employers cut more than 150,000 jobs in October. That's an increase of 180%, the largest monthly reduction in more than 20 years, according to global outplacement firm Challenger Gray and Christmas. The increase was led by tech companies, with more than 33,000 job cuts announced. Amazon last week saying it would cut up to 14,000 jobs from its global corporate workforce. Well, the US government shutdown has extended into a 37th day, a record, with government data disruptions adding to market uncertainties, with tonight's closely watched non-farm payroll report expected to be postponed. FOMC member Austin Goolsbee saying a lack of inflation data during the shutdown makes him uneasier about continuing rate cuts, saying if there are problems developing on the inflation side, it's going to be a fair amount of time before we see that. That makes me even more uneasy. When it's foggy, let's just be a little careful and slow down. Well, elsewhere, the Bank of England kept its policy rate unchanged at 4%, as widely expected, and Norway's central bank also leaving its policy rate unchanged at 4%. US Treasury yields have dropped on concerns of a weakening US labour market, as well as questions over the legality of President Trump's tariffs. The 2-year yield falling to 3.54%, the 10-year is around 4.08%, the US dollar down around 0.5% on the day. The Aussie, it's fallen back below 65 cents to be at 64.8 US. Oil prices have fallen further as investors consider a potential supply glut, as well as weakened demand in the US. Brent crude down to $63 a barrel. Copper is off slightly. Iron ore up around 0.5% to 103 a tonne. And gold was buoyed by a weaker US dollar. It's currently sitting at around $3,980 an ounce. And risk-off sentiment has seen Bitcoin fall back to 101,000 US dollars. Well, let's get more on what we're seeing on US markets. Dave Sekera is the Chief US Market Strategist at Morningstar. He joins us again now. Dave, great to catch up for our monthly chat. Let's take a look then at what you're seeing. Now, a lot of talk about stretched valuations there. How are you seeing the market at the moment?
Yeah, I mean, as you talked about, today was a pretty tough day in the US markets. And in fact, just looking at the market action really over the past couple days, I think I'm starting to see some buyer fatigue in artificial intelligence, specifically without any new news coming out to send AI stock valuations higher. Kind of feels like AI names right now are running out of steam. In fact, one name I was just looking at, before we got on the air here is Oracle. Now, it's interesting if you look at the stock market action on this one. In early September, the company announced, a new 5-year projection for its cloud business, essentially to go from a $10 billion business, in last year's revenue up to, I think, 144 billion by 2030. Looks like the market's calling the company out on that one. That stock has now fallen enough. It's round tripped all the way back to where it was, prior to that announcement. So I think it's interesting, seeing some of the underlying market action. And I think it also really makes people focus a little bit more on artificial intelligence as far as, which of those companies have very sound underlying fundamentals and businesses away just from the AI growth, which is where some of our better picks are today, as opposed to really some of the more speculative bets on AI, which I think are the ones that are rolling over the most right now.
I'll get to that in just a moment, Dave. Let's take a look at your style box you got there at Morningstar and where that is at right now. Just talk us through what you're seeing there.
Yes, I mean, overall, the market's trading at a 2% discount to a composite of our fair values. We take a different approach than what you're going to hear from a lot of other strategists when we come up with our market valuation. We cover over 700 stocks that trade on U.S. exchanges. So we'll compare the market capitalization of those divided into the intrinsic valuation as determined by our analyst team. So really that bottoms up view as far as market valuation. Now, we are kind of a market weight recommendation overall at the broad market level, but within that equity allocation, I'd still look for a slight overweight in value stocks that is trading at a discount to fair value, and on a relative value basis, looks better than growth stocks. And by capitalization, we still like small cap stocks. I know you've been hearing us talk about that, all year, but from capitalization point of view, that is still where the best value is. And then just lastly, just to wrap it up on growth. So while growth stocks are at a slight premium, we still see value in some idiosyncratic situations today. Specifically, a lot of the software names we think are significantly undervalued. A couple that I'd highlight would be Salesforce. That one trades at a 27% discount to our fair value. Workday at a 26% discount, and then lastly, ServiceNow at an 18% discount. So while the growth space, may appear fully valued to slightly overvalued, still some interesting picks there from our analytical team.
Dave, ongoing concern about that market concentration among the mega cap tech stocks. How concerned are you about that? And perhaps that's why you're looking further down the scale and towards those small caps.
Yeah, and when we look at the concentration, I mean, these mega cap stocks just become increasingly larger and larger. And to be honest, I mean, some of the numbers for the market capitalizations, when you think about just even small percentage moves, are huge moves on a market capitalization basis compared to a lot of the other stocks, in the U.S. But right now, 8 of the top 10 largest stocks in the U.S. all tied to artificial intelligence. You look at NVIDIA, I mean, that was only about 1% of the market cap in 2020. It's now over 7%. So I think investors have to realize, even if they have, most of their exposure in like maybe a broad market index or ETF, they're still very heavily exposed to AI-driven returns. So for those that are looking to reduce that concentration risk, or maybe they just don't have appetite for such exposure in AI, that's when I would recommend diversifying into that value space, into small cap stocks, both of those trading at discounts to fair value, but also both having pretty minimal exposure to the AI trade today.
And sector-wise, how are you breaking this down in terms of what's overvalued and undervalued?
Now, the most undervalued sector is communications. That trades at a 15% discount to our fair value, so that is the most undervalued. But of course, to be honest, I mean, to some degree, that's all about Alphabet. Alphabet is a huge market weighting within that sector. That is a 4-star rated stock that trades at a 16% discount. So that is one that we still see value today, that you get both the good, strong underlying fundamentals of the ongoing business, but you still capture that upside in the AI growth. But if you're looking for more traditional communications names, I'd highlight Verizon. It's a 4-star rated stock at a 25% discount, pays a very healthy dividend yield at 7%. Other than that, I still like real estate. Now, personally, I'd still steer clear of urban office space. I prefer real estate with defensive characteristics. Something like Ventas, which does a lot of senior housing, has been performing, exceptionally well. In fact, since we recommended that about a year ago, it's gone up almost at the same rate of NVIDIA over that same time period. It's still a 4-star rated stock at a 7% discount. And lastly, energy. You talked about oil. Oil's still kind of struggling. What I like about energy is I think we have a pretty, conservative estimate for oil. Like our forecast for West Texas Intermediate is $60 a barrel over the long term. But yet, even including that in our models, we still see a lot of value in these names. Among the global majors, our current pick is going to be ConocoPhillips. It's a 4-star rated stock at a 20% discount and a 3.6% dividend yield.
Now, Dave, in terms of those mega cap AI stocks, you've mentioned Alphabet, why you're liking that. I see Microsoft is also on your list. Why is that?
Yeah, it's a kind of the same story that, I think AI is additive to growth here, but fundamentally the company and all of its other lines are still really hitting on all cylinders. This past quarter, revenue and earnings both beat the high end of guidance pretty much in every one of their business lines. Their guidance was in line with our expectations and pretty much with forecasts, as well. Now, some people, might bang on the stock because revenue was slightly low, but their margin expectations were better. So I think that makes up for it, in the earnings growth. But to me, I really like the stock because what we noted was coming into earnings, we were looking for acceleration in Azure. That's their cloud hosting business. We're looking for growth there to continue accelerating at an accelerating rate. So it's 39% last quarter. That surpassed guidance of 37%. And with the amount that they've been spending on CapEx in the first half of the year, as that capacity comes online, in the end of this year and into 2026, I think we still get a lot more growth, a lot more total addressable market there for them to capture.
And Dave, just briefly, outside of AI as a defensive play, Coke is on your list. Why is that?
This is a stock that rarely ever trades at a discount to fair value. So this, in our mind, is really kind of a rare opportunity to be able to get, that really high quality brand, a company with a wide economic moat. It's a 4-star rated stock at a 7% discount, pretty healthy dividend yield, at 3%. So I think for people that are looking to move into, some more defensive positions with everything that's going on in the market today, the market's giving you a gift on this one.
Dave, great to get across what you're seeing on the market at the moment. Thanks for joining some Morningstar.
Of course, thank you.
Well, let's return to the local market ahead of the open here on this Friday. Let's call that a flat start that is expected given SPI futures are down just 2 points. Focus will be on some further updates in earnings, particularly from Macquarie Bank, has been big for the banks this week. Also a number of AGMs to get across too. Stay with us. We'll get across the open in just a moment.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.